Hello traders. One of the first technical tools that you will come across in your trading journey is that of the moving average. It is a very popular tool because it identifies the direction of the market. Let me remind you the three market directions: up, down, and sideways. Easy, right? Excellent. Now, when prices move above the moving average, we might assume that the market is following an upward path or it is in an uptrend. Similarly, when prices fall below the moving average line, then a downtrend is in place. And when prices fluctuate up and down the moving average, then what we have on our price chart is a sideways market. The moving average is a lagging indicator as it suffers from delays in identifying buy and sell signals. One of the important parameters that we need to choose for the moving average is the period. For example, 50 periods, 100 periods, 200 periods. What it means is that if we choose, for example, 50, then to calculate the most recent moving average, then we need to estimate, we need to compute the average of the last 50 prices. And similarly, if we choose 100, we calculate the average of the last 100 prices. And then once more, if it's 200, the average of the last 200 prices. You get the point. Now, the longer the period, the longer the lagging factor. So keep that in mind. It's very important. If, for example, you choose 200 period, then the lagging factor is high. If you choose 1 period, right, then the lagging factor is not there, but you get most probably a lot of false signals. Good, keep that in mind. Next, how do I choose the correct moving average period? The answer is there are different ways to do that. But in this context right here, we will follow the market convention. In the foreign exchange market, we use 10, 20, 40, 50, 60 periods. In the stock market, the convention follows like 100 or 200 periods. Of course, the choice is yours. You can do your research and come up with a different number. The third direction in the market is the sideways direction. It is very risky to trade, especially using a moving average tool. It is very risky to trade using a moving average because it triggers a lot of false buy and sell signals that will cost you a lot, that will make your trading account suffer. So when I identify a trendless market on the price chart, I avoid using the moving average just for this reason. Now you know the moving average, you know the pros and the cons, the advantages and disadvantages, so use it wisely. See you in a bit.
Hi guys, don't forget to subscribe and press the bell to keep up with new videos.